Have you ever wondered if you're buying into the stock market at the right time or maybe the absolute worst time? Well, today we're going to break down a Nobel Prize-winning tool designed to answer that very question. It's called the CAPE ratio. We're going to see how it works, what it's telling us, and how you can use it. Let's jump in.
I mean, this is the big question, right? The one every single investor faces. Are you looking at a massive opportunity, or are you walking straight into a dangerous bubble? Getting this wrong can be incredibly painful, and trying to find a reliable signal in all the day-to-day market noise, well, that's the real challenge.
So here's our game plan. We'll start with why the most common tools can actually mislead us. Then we'll dive into Robert Shiller's much smarter solution. We'll decode how it's calculated, look at its incredible 100-year track record, tackle the big debate around it today, and then wrap it all up with how you can actually use this for your own long-term planning.
All right, first things first, we need to talk about the most popular tool out there for valuing stocks, the standard price-to-earnings ratio, and why it can often point us in the completely wrong direction.
See, the standard PE ratio has one giant flaw. It only looks at a single year of earnings. Now think about that for a second. In a huge boom year, earnings are through the roof, which can make the market look deceptively cheap. But what happens in a recession? Earnings crater, making stocks look super expensive right at the moment they might actually be the best bargain. It's like a broken compass. It gives you the absolute worst signal at the worst possible time.
And this is where Nobel laureate Robert Shiller enters the story. He saw this exact problem and created a much more robust, a much smarter metric that's designed to filter out all that short-term economic noise.
And here it is, his brilliant solution, the CAPE ratio. The real magic is right there in the name, cyclically adjusted. Instead of one wild, volatile year of earnings, it smooths things out by averaging them over an entire decade. And, this is crucial, it adjusts all those past earnings for inflation. This gives you a much clearer and more stable picture of the market's real underlying value.
So how do you actually calculate this thing? I know, it sounds pretty complex, but the process is surprisingly straightforward. Let's just walk through it together.
It's really just a four-step recipe. First, you take the current price of the market, say the S&P 500. Then, you gather up the last 10 years of reported earnings. Now here comes the key ingredient. You adjust all those past earnings for inflation, so you're comparing apples to apples in today's dollars. Finally, you average those 10 years of real earnings and divide the current market price by that nice, stable, long-term average. It's simple, but man, is it powerful.
Okay, a fancy metric is one thing, but does it actually work in the real world? Well, let's take a look at the CAPE ratio's pretty incredible track record over more than 100 years of market history.
This right here is the whole ball game. The relationship is basically inverse. When the CAPE ratio is high, it means stock prices have gotten way ahead of their actual long-term earning power. And history shows, again and again, that what gets stretched too far tends to snap back, with pretty disappointing returns over the next 10 years.
Let's look at the most extreme example we've ever seen. December 1999, the absolute peak of the dot-com mania. The CAPE ratio rocketed up to 44.2, the highest it has ever been. It was basically a giant, flashing red warning sign of what Robert Shiller himself called irrational exuberance.
And what happened next? Well, the prediction was painfully accurate. The following decade delivered an average real return, that's after you account for inflation, of pretty much zero. It became famous as the lost decade. If you bought at that peak, you made no real money for 10 straight years. Ouch.
Now let's look at the complete opposite. Go to early 1982. After years of brutal inflation and economic malaise, people were beyond pessimistic. The CAPE ratio plunged to just 6.6. This was a signal of profound undervaluation. Prices were just ridiculously cheap compared to their long-term earnings power.
And what followed all that doom and gloom? You guessed it. That moment of peak pessimism marked the start of one of the most powerful bull markets in American history. It generated unbelievable returns for anyone brave enough to buy when the CAPE was flashing green.
Look, the main point here is that this isn't some one-off fluke. The CAPE ratio has an amazing history of signaling these huge market turning points. It peaked right before the 1929 crash. It bottomed out just before that massive bull market in the 80s kicked off. And it hit its all-time high right before the dot-com bust. A track record like that is pretty hard to ignore.
But that brings us to today. And this is where things get really interesting, because for much of the last decade, the CAPE ratio has been stuck at historically high levels, flashing a warning sign. And that sparked this massive debate. Is the tool broken, or are we just ignoring a critical warning?
This is the million-dollar question, isn't it?
Has something fundamental about our economy changed so much that the old rules and the CAPE's historical average just don't apply anymore? Is this time really different?
The debate really has two main camps. On one side, you have people arguing that things like persistently low interest rates and changes in accounting rules totally justify a new normal of higher valuations. They say the CAPE just looks high, but it's not a real warning. But on the other side, you have people who say not so fast. They believe in something called mean reversion, the idea that what goes way up must eventually come back down to the average. For them, a high CAPE is a timeless measure of dangerous investor optimism, plain and simple.
Okay, so with that whole debate going on, how can a normal, long-term investor like you or me actually use this thing? Let's get practical.
And this is probably the most important takeaway of all. The CAPE ratio will not tell you what the market's going to do next month or even next year. A high CAPE can get even higher and stay that way for a long time. Its real power is as a tool for setting realistic expectations for your returns over the next decade.
So, how can you apply this? Well, first, use it to set realistic goals. If the CAPE is sitting up at 30 or higher, don't expect the historical 7% real returns. Maybe budget for something closer to 2 to 4%. Second, let it guide your big picture asset allocation. Maybe you lean away from markets that look really overheated. Third, just think of it as a thermometer for market sentiment. Is the room full of euphoria or is it full of fear? And finally, use it as a tool to stay disciplined. It forces you to anchor your decisions in long-term value, not get swept up in all the short-term hype.
Ultimately, everything we've talked about comes down to this one simple, powerful idea. The CAPE ratio is a constant reminder of one of investing's oldest truths. The price you pay today is the single biggest factor in determining the return you get tomorrow. And that, my friends, is a lesson that never, ever goes out of style.